Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik, and in this video we're going to be doing a brief stock analysis on Sherwin Williams stock, ticker symbol SHW. So I do not own this one, but it's something I've been looking at for a while, and as you guys probably know, they are a basic materials company. Their main products, are chemicals in the form of paints, but they do have some other stuff. But just looking here at, first of all, their Q3 results for the third quarter of 2021. They announced those at the end of October, and those are for the quarter ended September 30th, 2021. So they reported consolidated sales of 5.15 billion, which was just a very small increase of 0.5%, and their sales from stores in the US and Canada actually decreased 2.8%, and raw material availability issues have negatively impacted their quarter sales by an estimated high single-digit percentage. So as a materials company, I think that's one of the big things that has been affecting them recently, probably is, increased materials costs with the supply chain and just issues there with availability of materials, and they also reported net income per share of $1.88 compared to $2.55 per share in the third quarter of 2020. And they had adjusted diluted net income per share of $2.09 from $2.76 in the third quarter of 2020. They also reported earnings before interest, taxes, depreciation, and amortization of $134 million, or 16.2% of sales. And then they generated net operating cash of $2.1 billion, or 13.5% of sales in the first 9 months of the year. And they say fiscal year 2021 diluted net income per share guidance is in the range of $7.16 to $7.36 per share. So we also are going to look just a little bit of a chart form. So net sales again, $5.15 billion compared to $5.12 last year, which is just an increase of 0.5%. And then their income, decreased about 30% before taxes and about 26% from a net income perspective. And they talk about their different segments here, basically split those results up for the different segments, so we're not really going to go through that here. And they do list the guidance. So net sales, they say the fourth quarter they expect it to be up mid to high single digit percentages from last year, and the full year 2021 sales they expect to be up high single digit percentages from last year. And they also have a short little balance sheet listed out here. So total current assets sitting around $5.4 billion, which is up just a little bit from $5.2 billion last year. And the current liabilities are at $6.5 billion, which is actually above the current liability or current assets right now. And that's up significantly, over $2 billion from the $4.4 billion that it was last year. And just looking through the line items of those that increased the most, so they had short-term borrowings of around $709 million right now, which was pretty much zero before. And they do have increased accounts payable by about $600 million. And I would speculate that some of that is just because of increased materials costs. So it's, the same, general volume of business per se, but just because of the increase of the cost to buy those goods, that accounts payable number is higher. So that's not, I guess, as big of a deal in my opinion. And then also another big increase here was the current portion of long-term debt, around $600 million. So it looks like they're going to be starting to pay some of that down, but the good thing is that long-term debt has been decreasing, around $7.6 billion right now compared to around $8.3 last year. So the total assets are $20.7 billion, which is down just a tiny bit. And then the shareholder equity is around $2.7 billion, which means the total liabilities are in the range of close to $18 billion currently. And also looking at their dividends, they do pay a small dividend with a yield of about 0.66%, with a very nice payout ratio around 26%. So that definitely tells us as shareholders they have a lot of room to grow that dividend. And they have actually been growing that dividend for 43 years, which makes them a dividend aristocrat, which is pretty awesome to see. And recently, over the past 5 years, they have been growing that dividend pretty well, around 14.5% on average over the last 5 years, which is something we really like to see, and that's something that I am really looking for right now for my dividend portfolio is just companies that have a really nice growth rate of that dividend and that can continue to grow that dividend. But at least for me, the dividend yield is pretty low, but we're going to look at some other things as well later that could help us determine whether we want to buy the stock right now. So we can look at the PE ratio, which is one method, a very basic method that is of valuing a company. And right now we can see the PE ratio is around 45, which is significantly higher. And generally speaking, it looks like the PE ratio has generally been increasing over the past 10 or 15 years, which isn't necessarily a terrible thing. The stock price has been increasing pretty quickly, and you can see the earnings have been increasing pretty quickly as well. So I just would like to see the earnings, increase a little bit more. Actually, obviously, you can see the recent quarter was a little bit of a decrease, which is all right. But we want to see those earnings increase a little bit and continue at a steady rate of increasing, because that will help to decrease the PE ratio, obviously, and make the company look a bit more attractive. And we want to also compare that PE ratio to the overall sector, and so that's the materials sector, and they're here in this chemicals industry. So as far as the sector goes, the average PE ratio is around 18, and for the chemicals industry specifically, it's around 20. So they're definitely well above double, the average for the sector and industry that they're a part of. So that's something that could be a little bit concerning. But if we look at the stock price, it's really been on a meteoric rise, over the past 5 years or so, ever since, the COVID crash here. In March of 2020, it was around $130 a share then, and now it's $330 per share. So well over 100% increase, getting close to a 200% increase since that time. And if we scroll in a little bit, it's interesting to me to see that they had these earnings here at the end of October, and the earnings definitely were not the greatest earnings out there for a company, but the stock has just continued to rise pretty rapidly even since those earnings, which is pretty interesting to see. And right now it looks like the RSI is indicating that it's a little bit overbought at this point. So for me personally, I would definitely like to see the stock price decline a bit on Sherwin Williams before I was looking to invest. I think right now the value proposition is just not quite there, as the dividend yield is pretty low at about 0.66%. The one great thing I like about the company is obviously they do have a super great track record of steadily increasing their earnings, which I would like to see a little bit more of, but also rapidly increasing that dividend for shareholders, which is something super awesome that they are doing. So for me, I'm not buying right now. I definitely like to see it under 300 before I even consider touching it, for sure. Probably even lower. But let me know if you guys do own the stock, or if you have any suggestions for where you would be more interested in buying if you were interested. But that's it for this one. I just want to thank you for watching to the end, and I will see you in the next one.